On a daily basis and a weekly basis, movements of the market are random. However, there are particular times when the market movement is very far from random. When the market generates data that tells you the market's close to a top or has topped, or the market is close to a bottom and has bottom. In their mind, this is cuckoo, this is nuts, this is impossible. We were taught this can't be done. So you need to have a discipline, and you need to have a view, and you need to rely on your data. If you don't rely on your data, you're just lost.
I'm about to sit down for a conversation with a man who is a very quiet Wall Street legend. He's worked for some of the titans of the industry. He's worked for Michael Steinhardt, he's worked with Stanley Druckenmiller, with George Soros, and the work he does is absolutely fascinating. This is going to captivate and entertain a lot of people. There's going to be some questions afterwards. So join me now, and we're going to sit down and talk with Milton Berg. Well, Milton, welcome. Thank you so much for doing this. I've been looking forward to it for a very, very long time.
Well, thanks for inviting me, and I'm going to learn more about Real Vision. I skimmed some of the videos this morning, and I feel better it wasn't on earlier.
Well, I'm glad we finally got this to happen. So just before we get into what you do, which is so fascinating, I just want to give people a quick sense of your background, because you've been in the markets a long, long time. So if you can just give us a quick potted history, that'd be fantastic.
Okay, well, my background was never in finance. I got degrees in Talmudic law in the 1970s, but I didn't feel I'd make a living out of that, make a profession out of it. So I started studying markets on my own. I was exposed to markets as a child. My uncles used to trade in the 60s and so on, in the 70s. And then I decided to study the markets. I received a CFA, one of the earliest ones, number 6881. Now they're in the hundreds and hundreds of thousands. Right. So one of the earliest CFAs. So I studied pure Graham and Dodd fundamental analysis. I thought that's what you have to know to do well in the business. I studied accounting and financial statement analysis and Graham and Dodd. But as soon as I got my first job, I realized two things. First, I realized that I'm competing with all these other fundamentalists. Sure. I have no edge. There are thousands of analysts who follow Graham and Dodd. Yeah. So that's one thing I realized. Secondly, I realized that on average, the typical analyst just has average performance. And a lot of the analysis doesn't really contribute to their earning money in the market. So I was exposed initially to Ned Davis, who was then working at J.C. Bradford's, the first technical analyst I was actually exposed to. And I was fascinated because I saw there's more to the market than what I perceived Graham and Dodd was teaching me. And from then on, what I did was I spent more than 30 years analyzing markets until I learned to focus on market tops and market bottoms. Mm-hmm. So my background was I started at Talmudic law. I started as an analyst for low-grade credits for a mutual fund organization. Then I started managing money for a mutual fund organization. I worked at Oppenheimer Money Management. I was managing 3 mutual funds in the 1980s. Actually, in '87, I managed the 3 top funds in the country. Yeah. At that time I already had the discipline of trying to call tops and bottoms. We got to 80% cash before the crash in October. We got raised the cash in September. Then I worked as a partner at Steinhardt. I took off for a few years, moved to Israel with my family. I then went to worked for George Soros with Stanley Druckenmiller, worked with Stanley at Duquesne, always did research. And over the last 6 years, I've been doing the same research I've done all the years for other firms, doing it for myself and marketing the research, selling the research to clients. So currently my clients really are the titans of the hedge fund industry. The type of work I do is very atypical. People look at it and they don't understand it. They don't necessarily accept it. But the clients people who've been dealing with me for years understand that it's much value added.
Well, let's get into that because it is different. It is something that people won't be familiar with. So just talk about how you built this framework and how you began to kind of assemble the pieces of the jigsaw.
Okay. Well, one thing I realized in studying Graham and Dodd, Benjamin Graham, was that Graham was actually a technical analyst.
Right. You see, already people are going to be going.
People who know Graham know at the end of his year, he said, we give up all research. And we're just going to look at the numbers. Yeah. People who know Graham, and Warren Buffett will tell you, in the last 5 years of Benjamin Graham's career, he would no longer do rigorous analysis of balance sheets. And he just look at numbers, PE ratios, price to book value, what the price of the stock is relative to his last 5-year high, which is really technical analysis. Yeah, sure. Benjamin himself, later in life, everyone knows he became a technician. But prior to that, even reading Graham and Dodd's security works from the 1920s and 1960s, he suggests that the only reason he is a value analyst is because experience shows him that it works. Yeah. He actually spoke in Congress. He was testified in Congress in the 1960s when there's a question of market manipulation, they asked him, why is it a stock that's trading for $20 and you believe it's worth $60? Why does it ever trade at $60? Why does it remain at $20 forever? In other words, the question is, if the stock can be undervalued today, why can't it be undervalued forever?
Sure.
Why? Why must the stock ever reach intrinsic value? And realize Benjamin Graham's whole theory was the theory of intrinsic value. He said, I have no answer to this question. It's a mystery. All I know from experience is that if you buy a cheap stock, eventually it will trade at fair value. That's his answer. It's a mystery. Once we're dealing in mysteries, I figured there must be many more mysteries than strictly value. So there are far many things we look at that create market movements other than value. And I think value, intrinsic value, is just a technical indicator. In Graham's thought, the more a stock is trading below its intrinsic value, the more likely is you'll make money because it's going to trade back towards intrinsic value.
Sure.
But there's no inherent reason for a stock to trade at intrinsic value. And of course, the question is a very valid question. If a stock can be overvalued today, why can't it be overvalued forever?
Yeah.
If a stock can be undervalued today, why can't it be undervalued forever?
Yeah, that's exactly right. So taking that into account, how do you then start to build your own framework using that and applying it to tops and bottoms?
So what I try to do is say, is the market actually a random movement, which we were taught in the schools? Actually, the CFA program goes with random movements, modern portfolio theory. Or is the market not necessarily random? Is there some edge you could have? Of course, Benjamin Graham does not believe the market's random because it wouldn't be an undervalued stock if the market would be random. If it would be efficient, everything would already be traded at intrinsic value. But the reality is, I found that the market generally is random. On a day-to-day basis, you have the talking heads on TV, and you have the analysts giving research reports every day, trying to analyze the reason for today's move, the reasons for tomorrow's move, maybe the reason for the next week's move, or most likely explaining the reason for last week's move.
Right.
But I found that on a daily basis and a weekly basis, movements of the market are random. However, there are particular times when the market movement is very far from random. When the market generates data that tells you the market's close to a top or has topped, or the market is close to a bottom and has bottomed. So what we call that is turning point analysis. At turning points, the data generated by the market is no longer random. In fact, if you take a bell curve, for example, and let's say you track something as simple as 5-day volume, and you look at the average 5-day volume, the center of the curve, you look at the extremes, you'll find that the extremes of 5-day volume are associated with turning points. Now, intuitively, it makes a lot of sense because you know at a market low, everyone's selling the stocks, there's high volume. But people haven't looked at that as a technical indicator. We say, we're not going to be one of those who panic and create the 5-day volume. We're going to wait for 5-day volume, greatest in 1 year, greatest in 2 years, greatest in 6 months. We track these kind of things. And that tells you there's an impending turn in the market. We see that's just one indicator, an increase in 5-day volume as an example.
So let's just jump back in time to 87 because that was a call you famously got right to the day. I mean, it's extraordinary reading the story of your work around 87. So take us back there and talk about in the days leading up to that and perhaps the month before September, what did you see and how did you go about making use of that?
Well, we saw a spike in volume on August 11th of 1987, a big spike in the 5-day volume that we look at. The market actually peaked a couple of weeks later, less than 2% above that level. So that was the first indication that something's going to change. Now, the logic of it is that if people why would the volume increase after the market's up 30%? The market's up 30% over the previous 12 months. Why all of a sudden are people jumping in and volume increasing? There's got to be a reason for it. And the reason is because people are now comfortable about the market and they're speculating. The market went up 30% for the last 12 months. Let it go up 38% for the next 12 months. So the volume is not just an indicator which is suggesting a turn in the market. It's telling you something. It's telling you that something in the nature of this market has changed. There are more speculative dollars coming into this market. That took place on August 11, 1987. I wrote many reports saying the top is not yet in. On September 4th, 87, the Fed raised rates for the first time. And that was all that was lacking from indicators that I look at. Again, to my opinion, raising rates is a technical indicator. They raised the rate 1/4 of a point, and that caused the crash. So it's not as if that 1/4 point had a fundamental effect on the economy. It prevented corporations from borrowing money. It had no effect at all on the economy at all. It had some effect possibly on psychology. Wherever it was, that combined with other things we saw in 87 suggested that the market was very vulnerable. Of course, valuations were the highest in history. Paul Montgomery, who did a lot of work on bond yield stock yield ratios, found that the ratio of stock dividend yields to bond yields were also the highest in history. So it wasn't strictly the price of stocks were the highest in history, but actually the ratio, the preference for stock yields over bond yields was the highest in history.
You know, when you think about 87, we had a very different market back then. We had a very different set of inputs, and one big player, the Federal Reserve, had a much lesser impact on markets.
Yeah.
You know, when you look at these technical indicators that go back so far, how do you adjust for today and the oversized impact that the Federal Reserve?
Laughing when you say so far. We have indicators going back to 1900.
Sure.
We track 30,000 indicators on a daily basis. So 87 is modern history as far as I'm concerned.
Yeah, no, absolutely.
But yes, the story is this, and this is also Benjamin Graham. Benjamin Graham has been misquoted, very much misquoted. They say that Benjamin Graham says that on the short term, the stock market is a voting machine.
Yep.
But in the long term, the stock market is a weighing machine. Benjamin Graham never said that, and it's very illogical to say that. Let me give you an example. At the 2000 top, there are many, many long-term companies not involved in the internet that were very, very undervalued. Right. Now, if stocks are fairly valued over the long term because the market's a weighing machine, why would a stock ever be undervalued if a stock has a 30-year history of earnings? It's long term. If in the long term markets are a weighing machine, let General Motors always be weighed, let General Electric always be weighed. It doesn't work that way. Benjamin actually said that the market is not a weighing machine. It is strictly a voting machine. Because he says, it's in the book, Graham and Dodd Analysis, he says because although possibly fundamental factors affect stock prices, and possibly monetary factors affect stock prices, and probably psychological factors affect stock prices, the reality was, in order for the stock price to change, you need a buyer and a seller.
Yeah.
So no matter what you're going to say about fundamental analysis, the actuality is that the given change of a price of a stock is based on voting, based on a buyer willing to buy at a certain price and a seller willing to sell at a certain price. So this is very important. Once you realize that the stock market is a voting machine rather than a selling machine, you also realize that most turns in the market, or nearly I'd say all turns in the market, are sentiment-based and psychologically based rather than fundamentally based. If the Federal Reserve makes an announcement, we're going to raise rates by 400 basis points, and the market is definitely going to collapse if they ever raise rates in one day 400 basis points, it's not because there's any effect fundamentally on the economy at all at that time. Because it takes time. Let's say now they're going to raise rates in 6 months. The market will collapse today. Yeah. There was no fundamental change in any company at all. It's just that psychologically people understood that this in the future will be very, very poor and it'll sell now. It's a vote. And someone might argue, oh, there's been so much inflation. When Volcker raised rates, in fact, markets went up. Yeah. And he raised rates far more than 400 basis points. But he didn't do it overnight. But the reality was his raising rates cut inflation, gave greater value to stocks, and psychologically the vote was companies will do better in the future, we're going to buy this stock.
But it's very difficult to quantify human behavior. I mean, markets are essentially the collective representation of human psychology. That's it. There's nothing more than that, really, to your point.
Exactly.
So how do you go about building some kind of framework that captures the uncapturable? Almost?
Yes. Well, let's look at the bottom in December. If you don't want to look at some of my notes, if I have it available. Let's look at the bottom in December of this year. Federal Reserve just raised rates. S&P was down 20%. Russell was down 27% in just a matter of less than 3 months, I believe. The peak in the Dow was in October. The bottom was December. The Russell peaked in August. Market's down nearly 30%. Now, we called the bottom to the day. We were 100% short on December 24th. By the end of the day, the market was up 4%. We were up 0.75%. We covered our shorts and went long on that day. Why? Yeah. What is it? And he asked a very valid question. It's difficult for a psychiatrist to evaluate psychology. How could a market analyst evaluate psychology? So just the example I gave earlier, when you see a big increase in 5-day volume, it's just a number, increase in 5-day volume, but it's telling you something psychologically. People who were unwilling to sell a week ago are willing to sell today. Or in order to induce the buyers to come in, prices had to come down to compensate for the fact that people weren't willing to buy. So let's look at December. From December 19th till December 24th, the day of the low, we saw a 5-day volume surge, highest 5-day volume in 2 years. We saw what we call a 10-day reverse thrust, which is the opposite of a advanced decline line surge. Okay. The number of stocks down relative to stocks up was also at a great extreme. And that's just a number. It's a data point. But why would all of a sudden people be willing to sell so many stocks to cause a 10-day advance decline line? Although we look at it as data, we look at it, it's actually psychology. It's actually
capitulation, yeah, sure.
It's capitulation. We saw the number of new highs and new lows on both a 1-year basis, 2-year basis, and 3-year basis. We're also at extremes. We looked at the 5-day rate of change of the S&P 500, and so on and so forth. And these are the kind of things that you look at bottom. So people, to us, it's just data. We calculate by the 30,000 indicators.
Yeah.
But it's my view, and I got this from Paul Montgomery, that all market turns are sentiment-based. There's no such thing as a market turn that's fundamentally based. It's all sentiment-based.
It's interesting because what we seem to have had in recent years are very sharp bottoms and very sharp tops. We don't seem to have these rounding top and rounding bottom patterns that you've had throughout history. Is that something that we need to be prepared to continue, or do you think we will see like a rounding top?
Okay. So look, bottoms in stocks are always V-bottoms, always. Tops in commodities are always V-tops, always. Now the question is why? Why do stock bottoms generally V and stock? And the reason is it's also psychology. In the stock market, fear is a far greater emotion than greed.
Yes.
Far greater emotion. When people are fearful, all of a sudden they look at the 401ks, they look at the brokerage statement, they look at the fact that they have these loans to pay off, where's the cash going to come from? So they panic at the lows. In commodities, which traded in the commodities market, it's really a zero-sum game. For every long, there's a short.
Yeah.
So the exposure to the short side is far more dangerous than exposure to the long side. If you're long a market, you can lose your capital. If you're short a market, you lose multiples of the market. Since commodities are a zero-sum game, the futures market, which for every long there's a short, the panic takes place when the market's rallying. Because every long had to have had a short. So that also proves that it's psychology that turns markets. In commodities, the psychology takes place at the top. The great dramatic shift in psychology takes place at the top, where everyone's fearful of losing money, covering the shorts, and then ultimately the market turns down. In the stock market, it's the other way around. Now, I don't necessarily agree that the nature of markets have changed. I still see generally in the stock market, on an intermediate-term basis, long-term basis, and short-term basis, I still see V-bottoms. But one change is you're seeing tests. For example, the low in 2000, you had a first low in July of 2002. Then the market gained more than 20%, made a new low in October of 2002. Gained 24%, made a slightly higher low in March of 2003. Each of those bottoms were V-bottoms, but there was a series of three V-bottoms. So you take a broader picture, you'll say, hey, it was a rounding bottom. I don't look at it that way because we don't take a broader picture.
Sure.
In my opinion, if you traded the market right, you got long in July 2002, you got out in August, made 20%. You get short, you got long in October 2002, you made another 20%, sold up 24%. You went short. So I look at it as 3 separate markets, each one showing a V-bottom. But the typical analyst, they say, well, typical will say, wow, if you bought in July 2002 and you held through the rounding bottom, you did very, very well.
Yeah.
You did very well, but basically did what the market did. You did what the S&P did. You're lucky to have gotten long if you were short, and you basically did what the market did. But if you recognize that every turning point in the market has suggested that turning point, you will attempt to do far better than hold the market. Now that we brought this up, let me just take it one step further. And this is really where people doubt what we do, and people don't understand what we do but we do it. If you invested $1 in the Dow Jones Industrial Average in 1900, January 1st, 1900, and you held, not look at dividends, just held, your $1 would have grown, you can guess if you'd like.
No, well, I thought you'd take a swing at that
It grew
one.
to $658, which is an amazing, amazing return.
Okay.
658 times your money.
That's to today.
That's to today.
Yeah.
This is actually till June 30th. So we're close enough, right? $658, which is, these long-term investors like the Nobel Foundation, who's been around for over 100 years, they could say, well, let me take a long-term view on stocks. $1 to $658 over a century, or a little over a century. That's amazing. I'll be able to give all my Nobel Peace Prizes out to whether they deserve it or not.
Right.
However, let's say somebody only traded 73 times over that 120-year period, 73 times. But he happened to buy stocks at the exact day of the bottom, and he happened to short stocks at the exact day of the top. Now, I'm not going to ask you to guess. That dollar would not be worth $600 or $800 or thousands of dollars. It'd be worth $392 trillion. It's funny. That's a 30.19% return over 119 years. Now, I'm not arguing that anyone can do that.
Right.
But I'm arguing since you can see how compounding market, bull market and bear markets makes you so much money, why not attempt to do it?
Sure, absolutely.
Why not attempt to do it? And like everything else in this world, there are many people may attempt to do it, and maybe it'll be one or two or a dozen people successful at it. But people really don't attempt to do it. I don't know anyone who has a hedge fund whose goal is to be 100% long during bull markets and 100% short during bear markets. They don't do it. The clients wouldn't think it's going to work.
I think that's it. It's the client side,
It's
right?
the client. Well, it's not
tough
the
to
clients.
find.
It's the consultant side.
Yeah.
It's the psychology side. It's the business school side. I just met about 2 months ago, believe it or not, with I'm not going to mention names, but a managing director of one of the largest money management companies in the world. They're looking to start hedge funds that can have high capacity. High capacity meaning at least $1 billion. Now, of course, if you're going to trade long the S&P and short the S&P, that's easily have a high capacity.
Sure.
I imagine it's 10 or 20 billion capacity. And I met with this fellow, and I said, I have a strategy for you. I have a strategy for you, and this is the strategy. We will attempt to go long at the top of bull markets, attempt to go short at the top of bull markets, attempt to go long at the bottom of bull markets. I said, we're not going to catch every top or bottom. And we're not even going to look at bull markets. We're going to look for 15% moves. We don't need every 30% move.
Right.
Just to let you know, if you count every 15% move since 1900, you have $6 quintillion, which is 18 zeros after the 6.
Right.
But the point being, we're not going to have that return. But we think we'll have returns far greater than the market. Let's outperform the S&P with a simple, transparent program. But in order for you to do the program, you have to have an edge.
Yeah.
Your edge has to be able to call tops and bottoms. We spent years and years analyzing tops and bottoms and trying to call edges. So this is what we do. This is what we offer to our clients. The ability to recognize tops, recognize bottoms, and understand that the movement in between is random. So while people are watching television each day, is the market, should I buy stocks, should I lose stocks? They read all the analyst reports. The reality is, if you caught the bottom, you can usually sit tight for quite a number of months before worrying about a top.
Yeah.
And if you caught the top, you can usually sit quite a number of months until you worry about a bottom. Now, I was talking about the sentiment psychology we saw in December. We have 27 buy signals beginning on January 4th, 27 distinct buy signals, all based on the fact that we've modeled every bottom since 1900, and we've modeled every top since 1900. We've modeled not only not only the 38 major bull and bear markets, we've monitored every move of 7% or greater. So we've modeled every move of 7% or greater. And I have to admit that we can't catch every 7% move. We can't even catch every 15% move. But if you only catch every other bear market,
Sure.
you'll still way outperform the typical hedge fund and the typical investor. So let's look at what happened this year and how we implement our work. January 4th, just a number of trading days. I think it's not even 10 trading days off the low. It actually was seven. It was seven because you had Christmas, you had New Year's.
Sure.
January 4th was 7 trading days off the low. The S&P 500 was up 3% on the day, and this took place 7 days off a low. Now, the background is when we're tracking tops and bottoms, it's very simple. How do we do it? If the market makes a bottom, we count 1 day off the bottom, no new low. 2 days off the bottom, no new low. 3 days off the bottom. We publish a report called Boundaries for Technical Analysis in the Market Technicians Journal. You see a low and you count the days after the low. What takes place during the first 4 to 7 days after a low, which is generally the key. So we looked at the low. On the day of the low, we saw an extreme of net new highs over total issues was minus 18.20%. That's a cutoff. That's an extreme. 7 days later, the S&P was up more than 1% on higher volume. And we looked at every time in history, you saw this type of a low, oversold low, and the 7th day after the low, the S&P was up just 1% or greater on higher volume. That only took place twice before, but the median gain 12 months later is 35.42%.
Right.
Now, people ask, it only happened twice before, but that's exactly the point. We're trying to find aberrations. We're trying to evidence that this time is different. If it happened 1,000 times before, then you're just a random analyst.
Right.
If it happened twice before, and each of those times the market rallied significantly, this is something significant. Just the opposite what people think intuitively.
Yeah.
People want thousands of examples. Well, if you get 1,000 examples, you get randomness. If you're going to get just a few examples of extremes, and this is very simple, oversold low based on the number of highs and lows, and at day 7, up 1% or greater on higher volume. Beautiful, simple.
Sure.
And we were already long on January 4th. That's the first buy signal. They said we had 27 buy signals. Another example, January 8th, very simple. This is not my own buy signal. I learned this signal from Ned Davis Research, from Ned Davis. I think Marty Zweig may have also contributed to this signal. There are many indices you can use. We use the New York Stock Exchange 10-day advanced decline was greater than 1.9 to 1. Very simple indicator. I think actually the chartist, it goes back to the 1960s. I think he also uses this indicator. You look at the 10 days advance over declines. If it's greater than 1.9 to 1, you buy the market. Now, historically, the median gain within the next 12 months is 22.01%. We've gained 15.60% through yesterday's close. Mm-hmm. So the point being is, this is very simple, but it's not a random event. You don't see the 10-day advanced decline line at 1.9 to 1 on a random basis. In fact, you generally see it within 10 days or 15 days off a major low. In this case, it came actually 9 days after the low. We're counting 10 days advanced decline line, including a negative day, which was 10 days ago, and you still had a 1.9 to 1. So what do? We don't just say, well, it looks to us that there's a high probability the market's going to go up. No. We tell our clients, if you're not long yet, get long. But what if it doesn't work this time? What if it doesn't work this time? You'll get out.
Right.
Because historically, we have a list of the drawdowns. And generally the drawdowns are less than 3%. So if you're going to market clients 3%, get out, lose 3%. But take the risk.
Yeah.
Follow the data, follow the indicator, and get into the market.
But this is trust. I mean, this comes down to trusting the data, right? Because if you can get people to trust it and get them to trust it for a long enough period of time, they'll see that over time it works.
This is getting people to trust
yeah.
that markets are not random
Yeah.
at turning points, and that it's possible to time the markets, that it's possible to get in close to a bull market low and to get out close to a bear market high. People do not believe it's possible. They just don't. I mean, I see it all the time. They don't think it's possible. I'm sitting to you and you're smiling, hey, this sounds great.
No, it's
when I
fascinating.
speak to someone who's never seen this before, in their mind, this is cuckoo, this is nuts, this is impossible. We were taught this can't be done.
Well, that's exactly it. We're taught it can't be done, so people don't try it. That's exactly right.
They don't try to do it. That's January 8th. I'm going to go through some, not all 27 indicators. I'm going through some of them. Then on January 9th, the next day, at the low, the 5-day volume was the greatest in 2 years. But we cut it off at 6 months. At the low, which was probably 12 days before, you had high 5-day volume. And on this day, the 10-day advancing volume over the declining volume is greater than 70%. This is our own indicator. Rather than losing advancing issues over declining issues, advancing volume over declining volume is greater than 70%, just those two indicators. This took place 6 times prior. The median gain over the next 12 months is 23.40%. Right. And the worst drawdown was only 5.6%.
Right.
So again, if the guy doesn't want to trust it, and the second worst drawdown was 2.7%. So let the person ignore the 5.6. I'll get out if it declines 2.6%.
2.7, sure.
It declined minus 0.09% the next day. That was it. The market continued higher. It's up 15.13% since then. I can go through many of these indicators. The point I want to make is that although we try to pinpoint the low, we also feel that close to the low, the information is not yet random. Once you get 2 or 3 months out of the low,
yep.
Generally information is random. Although we did get a new buy signal yesterday, although we're short, which is kind of funny, but we got a buy signal. The buy signal that we got yesterday is based on 5-week advanced decline line. Now, 5-week is a very blunt instrument. You look
Sure.
at 5 weeks of data.
Yep.
So it has very, very huge drawdowns of as much as 11%. Although each time you saw this indicator, the market was up significantly over the next 12 months. But it's not an indicator where I tell a client, buy based on this. I say to the client, you should have bought in January. You'd be holding and sitting pretty right now.
So how do you do that? Because you have so many indicators. How do you prioritize them? How many do you need to kick in? Because I'm sure you have conflicting signals happening all the time. How do you see through the fog? I mean, this may be the secret.
You're asking the best question. There are no conflicting signals. Generally, there are no conflicting signals. Because what we do is we count days off a bottom. If you're counting days off a bottom, by definition, you're not going to get a top indicator.
At the same, but sure.
We're all looking for we modeled the hundreds of bottoms since 1900. We're counting 1 day, 2 days, 3 days, 10 days, 12 days, 15 days off a low. You're not going to get a sell signal if you're counting days off the low.
Right.
If you're going to get a buy signal. So same thing with the top. Now, top is a little bit broader, as you mentioned earlier.
Yep.
But we also say the market is up 5, 6, 8, 10%. Such and such has taken place at this level. I don't want to say that there are no conflicting signals, but conflicting signals are very, very rare. Now, how do we combine it? Well, we spent 30 years creating these models. We have a huge computer database, and our computers combine the models. We combine it based on rarity. So on any given day, if there are 6 rare indicators, the computer combines it and see in the past whether these 6 rarities made any change in the market. So it's somewhat computerized. Of course, I have to pull the trigger. It's not a systematic type of trade, but it's serious work. First, I have to believe that it's doable. Now, why do I believe it's doable? Almost everything I've done, I've learned from people. First of all, I mentioned Ned Davis, my first exposure to technical analysis. There's a great market technician named G. Stanley Druckenmiller. He was around for maybe 40 years, and he taught me that the key to a market is what took place at the bottom and what took place at the top. Unlike everybody else who's trying to find information on a daily basis. That's what I learned from him. But I also learned, again, any technician who was successful in calling some tops and some bottoms taught me that it's possible. So Marty Zweig was a fellow I tracked over the years. And of course, my favorite technical analyst of all time, no longer with us, was a good friend of mine, was Paul Montgomery. And Paul Montgomery, a little bit about his history, he was a major researcher. He's the one who developed the hemline analysis, if you remember that one, back in the 60s and 70s.
Yeah.
And he used to use newspaper headline cover, magazine cover, Time magazine, and that was all Paul Montgomery. But what he discovered, and I'll tell you how he discovered it in a moment, is what's called cycle turning points. That sounds very strange. We're talking about data. What's a cycle turning point? What is it? Now, he had many of those, and I'd say he sort of mentored me in how to use it, and I sort of developed a little bit further. But once we've established that all market turning points are psychologically based rather than fundamentally based, or sentiment-based rather than fundamentally based. In other words, not the rational part of your brain that's getting you to sell it to the lows.
Yep.
Not the rational part of your brain that's getting you to buy the high-tech stocks in the year 2000 paying 160,000 times earnings that we'll never have.
Right.
It's not the rational part of your brain, it's the emotional part of your brain. Now, Paul was a manic depressive, which is very, very helpful in analyzing markets, because the markets themselves are manic depressive. And he found out that when he gets depressed, it's at the same time markets are bottoming. And when he gets exuberant, it's the same time that markets are topping. So he realized there's something affecting him and affecting the markets at the same time.
Yeah, it makes sense. I mean, it really does make sense.
In other words, what's affecting him is affecting the markets. So I'm going to give one of his cycles, which is our favorite cycle, and that is called the eclipse cycle. Now, I don't know if you know much about eclipses, and I don't try to study too much about the solar system or about eclipses, but you know that the electromagnetic and gravitational forces on the world are far greater during eclipses than, for example, the earthquakes in California we just had took place in the July 2nd eclipse. Of course, when there's an eclipse, you have the sun and the moon in the same direction, pulling at the tides, pulling at the earth, and that causes a physical change. But the eclipses also cause an emotional change. It causes a shift in people's psychology and people's sentiment. So we monitor eclipses, and the full moon and the new moon adjacent to the eclipses. So every eclipse gives an eclipse cycle, 2 cycles before and 2 cycles afterwards, because the eclipses, the sun and the moon, affect psychology.
Yeah.
Now this sounds, what's this guy talking about? Well, let's look at what happened over the last year. The Russell 2018 peaked on a cycle date. The S&P 500, September 21st, peaked on a WGAN cycle date, which is not quite eclipse cycle date, right? December 24th was one of our cycle dates based on the adjacent to an eclipse. July 2nd, which so far is the latest high in the market, when bonds peaked now, which I think is a major peak, is on an eclipse date. Bitcoin is having major cycle, and I'll show you the charts later on. Bitcoin had major cycle turns on these cycle dates. Why is it? The more a commodity, the more a capital market is affected by psychology, the more it's likely to cycle. So gold is always a prime cycle because there's no intrinsic value to gold. There's intrinsic value, but most of the gold mined, unlike any other commodity in the world, nearly all gold that has ever been mined in the history of the world is above ground.
Still there, yeah.
Still there.
Yeah.
So very hard to say there are fundamental factors affecting the price of gold. It can't be mining. People say it's Federal Reserve. It's not really true. Gold is strictly a psychological commodity. So gold has traded very, very well in the cycle.
But this is fascinating to me because a friend of mine, Mark Yusko, gave a presentation back in May that I saw, and he was they were trying to kick him off the stage. He was rattling through the rest of the stuff he had to talk about, and he very quickly threw in a study of full moons and new moons, and the returns that you would have made if you'd invested around that basis. And when he brought it up, the room kind of sniggered.
Yeah.
Which I find fascinating because we know that the moon has an effect on us. We know that. We know it's people laugh at it.
There's a caveat. This is very important. And I'll tell you why they snickered. They're right in snickering. Because if you'd stop me right here, you'd have to snicker as well. The moons themselves do not affect markets at all times. Every eclipse doesn't affect markets at all times. It's only when there's a combination of factors. People are already exuberant about a market or very depressed about a market. That is when the moon affects the turn. You need a combination of factors. So we never ever trade a cycle based on the moon itself. So for example, with bonds making multi-year highs on July 2nd, with people shifting money out of equity funds into bond funds, all these sentiment reduced, that told us that it's possible that July 2nd will be a top for the bond market. We went 75% short the long bond on July 2nd, and our stop is, if it ever gets above that level, we're stopped out. Right there, we're making money. So the snickering is because there's a moon every month. And markets don't turn every month. So how can you argue that the moons turn markets? But if you understand that the way the moon works is it shifts the sentiment from depressive to manic, or from manic to depressive, you wait for signs of the mania, for example, 5-day volume. December 24th was a cycle and it turned the market, but associated with that was the highest intraday put-call ratio in history. So the moon affected me, but I already was affected by the market. So that's very important to keep in mind. I'm not a lunar guy. I'm a data guy, but I accept that the moon, and I accept the things I've learned from my mentors, that the moon does affect markets if you know how to analyze it.
So why do you think it is? Because you said to me that people don't understand what you do, and a lot of people struggle to believe it, and you have these perception problems. What is it about us, to bring it back to psychology? Why do we find it so difficult to accept stuff like this that's very heavily backed by the data, that just to some people seems a bit kind of quirky? Why do we as humans struggle to accept it?
Well, firstly, we're taught that we live in a very rational world. We're taught that the Federal Reserve lowers rates, markets go up. In fact, it's once a technical indicator. Federal Reserve lowers rates twice. It was 3 times, markets rallied, because that was the case until 2000. All of a sudden, in 2000, you have a bear market, Federal lowering rates all the way down. 2007, 2008, bear market, Federal Reserve lowered rates before the market peaked. They lowered rates in September while the market peaked in October. But people want it to be rational. People are much more comfortable living in a rational world. And I'll tell you something else I've discovered about this business. I'm not going to mention any names. But some of the greatest money managers have some mental quirks. They're either the autistic spectrum, and there's a reason for that. Because when you are on the autistic spectrum, you don't follow conventional wisdom. You're able to see things a little bit differently. So the people who snicker, or the people who can't accept it, are very rational people. They can't get their mind to focus on something other than something they've been taught. But people who have some personality quirks, many of the great money managers are known to have.
Absolutely.
Part of that disability gives them the ability to look at things in a little bit different way, do things a little bit differently.
But some of the guys you work for, some of the big name hedge fund managers you work for, are very famous for talking about ignoring tops and bottoms and sitting in the belly of the trend. And if I miss the first 10% and the last 10%, I'm okay with that. When you look at that, how does your work jibe with that sentiment of trying to just capture the trend as opposed to the turning points?
I'm not sure which of these money managers you're talking about. I will tell you, I don't like to mention names, but I will tell you, George Soros is an excellent breakout trader. He buys breakouts and he shorts breakdowns, but he's very disciplined. He's very disciplined. So he can write many, many books about fundamental factors in markets, but you watch him on a trading desk and you'll see that his buying is not based on the fundamentals alone, it's based on the fundamentals combined with action of the commodity or stock or currency you're looking at. I would say buying a breakout in reality is you're not getting the bottom, you're not getting the low. If a market, let's say you have gold at bottomed at 1,000 and it churned and it's breaking out at 1,300, you're buying the breakout, you can argue you're taking the belly of the move.
Sure.
But the reality is what's getting you to, what's making that trade, what's giving you the confidence to make that trade is that pinpoint breakout, that move from $1,301 to $1,302.
Right.
So we're trying to do it at the exact turns. These people are doing it at breakouts, but they're still following the same type of discipline.
Yeah.
No one's out there saying, the market's up 15%, we're in the belly of the move, let's buy. None of the successful managers are doing that. These are the losers who are doing that. These are the people who are giving me the data that suggests the market's at the top. Those are the ones who do it. But I've worked with some of the greatest investors and traders on Wall Street, and they all have an edge, and they're all non-conventional.
Yeah.
And there are some people who are so-called trend followers, but even trend following has a discipline. It's not just markets up and down. There's a discipline to trend following. So you need to have a discipline, and you need to have a view, and you need to rely on your data. If you don't rely on your data, you're just lost.
So when you look across the landscape now, do you see anything that's got your radar twitching? Do you see any imminent tops or bottoms in any asset classes
I'm glad you phrased the question the way you phrased the question, because I never see an imminent top. I never see an imminent bottom. I only see probabilities.
Yeah.
I never see a top or a bottom. Where you make one mistake, you miss the bottom, and I was 175% short into December 24th. I missed that one bottom, and I decided I have no evidence for low. I'm 174% long with the SP up 22%. That's crazy.
Yeah.
So I look at probabilities. I went long, and I say, based in history, there's a strong probability that the low is in. But since I look at probabilities rather than assuming that the market has turned, it gives me the flexibility to get out, because if I get out, I know, well, it's a 99% probability. There's a 1% chance I was wrong. So the way you phrased the question was, what am I looking for at this point? That's the question. Well, this is where I look. This is where I'm looking at the current market. We had a major low based on the data in December. Major low. Really major. I said the highest intraday put call ratio in history. The number of lows relative to the highs. You had a record on a 5-day basis of net downside volume to upside volume. You had many extremes, which told you most likely we're headed for a new bull market. I called it a new bull market rather than a bear market rally.
Yep.
However, and I have 27 buy signals since then, which suggests on a median basis, the market should reach, I have the number right here if you don't mind, 3276.43.
Okay.
On a mean basis, 3320.65, based on the mean of those 27 indicators looking at the history. However, there are things bothering me. The one that's bothering me is that the market is acting as if it's in a bear market rally. Now, what does that mean? S&P's at a new high, Nasdaq's at a new high, the Russell peaked in 2018. The New York Stock Exchange Index peaked in January of 2018. Worldwide markets, believe it or not, most of them peaked in 2000 or 2007 when adjusted for the US dollar. So, but even on a short-term basis, with the S&P at new highs and the Nasdaq at new highs, there are too many lagging indicators. There's not a reason for me to go short.
No.
But there are other factors involved. I know that there's a time bomb that grows every day. I don't know if time bomb is the right word to use. But there's something going on underlying our economy on a fundamental basis that's going to ultimately cause a major collapse, and that is the debt outstanding. Mm-hmm. If you look at all government debt, state, city, local, it's about 176% of GDP. Yeah. If you look at off-balance sheet, pensions, and loan guarantees, we're approaching 350% of GDP. Now that can't continue. Another thing I bear in mind, which is very important, is that this great bull market we had beginning in 1982 until today, great bull market took place in conjunction with a great bull market in bonds. 10-year treasury yields are down from 15.75% to, at the low in the cycle, was less than 2%. Yeah. This has goosed markets worldwide. On top of that, you had the quantitative easing and all this other stuff. Yep. So you had a great bull market that began in 1982 that, in a sense, may have occurred only because of monetary easing, maybe only occurred because of interest rates coming down. Maybe the only reason companies were able to grow to the extent that they had was because rates were coming down. They were able to borrow free money.
Yep.
And certainly, So I'm afraid that one day that's going to backfire. We're going to get a turn of the cycle. Now, this is fundamental talk, but my data, so the way I say is anytime I see evidence of a top, I'm going to assume that this is it until I'm proven wrong.
Yep.
So we just went from, on the year, we have two portfolios. One is up about 26%, one is up 28%. And we were long most of the year, a couple of short periods of short trades which failed. We got out quickly. We went short on July 2nd. We went short the S&P, we went short the NASDAQ. Why? A, it's a major Montgomery cycle date. B, we have a list of more than 100 indicators that we matched to previous market peaks. And of all these 100, only 2 are inconsistent with levels seen at market peaks. PE ratios, investor intelligence sentiment, the number of new highs, the number of new lows. I may have I can tell you, I don't have my list on me right at this moment. But the reality is, everything is consistent except for one thing, except 30-year bonds on a 6-month basis and on a 12-month basis are doing far better than they've ever done at a final market peak. So, but I say to myself, A, that's only one indicator, it's the bond. Secondly, hey, maybe this time, since the whole bull market may have been generated by the fact that bonds are doing so well, maybe the hook at the final peak in this market will be the bonds are still doing well, and bonds are making their top coincident with the market top. So bonds have done very well the last 6-12 months into July 2nd. We went short the bond market for that reason, because this cycle may suggest a turn in the bond market. Sentiment is totally suggesting that the bond market is going to turn, because worldwide, everyone's buying U.S. bonds. The only place to get yield, the only place to make real money. Now they're saying about stocks as well. So we shorted bonds, we shorted stocks, and for all I know, this is it. However, I have 27 indicators telling me it's going higher.
Right.
So I short July 2nd. We have a stop slightly above the highs of July 2nd. If we're stopped out, we go back long stocks again. I'll retain my bond short, because bonds have far more than cycle work involved. Bonds really are giving off signals of a top. But again, if I'm wrong, I'll get out quickly. Very important, flexibility. You must remain flexible. You must know that everything works on probability.
Yeah.
There's no such thing as 100% being correct. So stocks and bonds are risky markets. Stocks are very risky markets.
Sure.
You recognize you're taking risk, and you recognize that you will not always be right. You also recognize that you have to know when you're wrong. And we have, since we're pinpointing turning points, it's so much easier to have a stop. Someone who buys because, the economy looks great, I'm going to buy stocks, how does he know when to get out? The economy's going to look great by the time the market peaks too. But if you say, I'm buying because we believe July 2nd was a top, or I'm buying because I believe December 24th was a low, if it makes a low below December 24th, you're out.
You're out,
It makes a high above July 2nd amount. So it's one of the benefits of our discipline.
So let me ask you, because this fascinates me, this idea of emotion and sentiment, it's ultimately confidence. Greed and fear are the extremes of confidence, essentially. What do you think is more important? Confidence in the economy, confidence in the markets, or, to me, what's become perhaps the most important is confidence in the Federal Reserve and confidence in what the central banks are doing, having this under control? How do you measure that, and how do you
I
react
agree
to
there's
it?
confidence, but you have to remember there's one more step. There's confidence and action.
Right.
Many people are confident, maybe confident the economy is going to do well, but that's not going to allow them to buy a speculative stock on margin.
Sure.
You see, people are confident, people are either confident or not confident. It's when the confidence translates into actions that a top is imminent, or bottom is imminent. If people are so confident the market's going much lower, they sell all the stocks and the turn is imminent. So confidence is one thing. We don't measure confidence. We don't measure sentiment per se. We measure how sentiment reflects in the actions. And where do you see the actions? In the data of the market. So now you're asking a question: is it the Federal Reserve? Is it the economy? Is it the market? The reality is, to me, it doesn't matter. I don't care if people are going crazy buying stocks because the Federal Reserve is easing. I don't care if people are going crazy selling stocks because the economy is tanking. Remember that at the low, Warren Buffett said that the economy is off a cliff. His companies are all off a cliff. That was in February of 2009, a month before the low. I don't care if people are selling because the economy is poor. I don't care if why they're buying or selling. I want it to show up in my data. So if I see investors in intelligence, for example, now in the danger zone of 57% bulls, which historically is a danger zone, that's not enough of a reason for me to sell stocks.
Okay.
But if that's going to be reflected in 5-day volume, as an example, this is one easy example. If that's going to be reflected in put-call ratio with high call buying, if that's going to be reflected in high volume and stocks moving to the upside, which is a narrow leadership, that will possibly give me a high probability trade to go short. It's very important to know that what economists mock about the stock market is one of the greatest things about trading the market. One of the things they say is, well, the stock market is called 18 of the last 5 recessions.
Right.
That's true, because the stock market is not perfect. But we're not trading recessions, we're trading the stock market. So if I could trade those 15 of those 18 tops without a recession, I'm happy.
Sure.
So what the economists are saying make no sense to stock traders. They don't realize they're speaking to investors, not speaking to economists. Economists want to predict the economy. They care that the stock market predicted only 5 recessions. But to someone who's trading, all I care is the market's going up or down. That's number one. But secondly, when I see that things aren't, I want to know that things aren't perfect. I don't want to ever get caught into the idea that I could be perfect or that markets are perfect, because that's when you're going to make a mistake. So I like the fact that even though the economy is a very good indicator for the stock, even though the stock market is a very great indicator for the economy, I'm glad to know that's not perfect. That should be perfect.
Yeah.
If anything should be perfect, it should be a stock market correlation with the economy, and that's not. So it's always important to keep in mind, in this business, nothing is perfect. It's all probability. We're not perfect. I've been in the business for quite a number of years, and I realized, my background wasn't finance, so I wasn't taught by the professors, by the academics, how markets are supposed to work. So I had to learn it on my own, and fortunately, I think I did a fairly good job for my clients, and hope to continue doing that.
Milt, that's the perfect place to wrap it up. We've talked longer than we said we would, and I could sit here all day because I find this stuff fascinating. But again, thank you so much for agreeing to do this and coming and spending the time with me. I've enjoyed every second. Thank you.
I really enjoyed it. Thank you so much.
Well, I promise you a fascinating conversation. Milton is, as I said, a very quiet Wall Street legend. He's a fascinating guy, and the work he does is truly extraordinary. And it splits opinion. A lot of people say, this is all bunkum and hooey, and a lot of people are fascinated by the work Milton does. But one thing's for certain, there's a rigor to it and a discipline to it, and his performance speaks volumes. So I hope you enjoyed that conversation as much as I did, and I hope I can tempt Milton to come back again. It's taken me a long time to get him to sit down with me for the first time. Hopefully the gap between this and the next time won't be so long.
Did you know that some of our shows, including the one that you just watched, are available on Real Vision Free? As the name suggests, this is our free channel that is distributed via cable networks, Apple, YouTube, and most importantly, the biggest finance websites. This aggregation means that Real Vision Free is one of the biggest finance channels in the world. In fact, it gets in front of 50 million active traders and investors. And you know what? You can sponsor our shows on Real Vision Free. If you want to put your company on the map, email us at sponsorship@realvision.com.